Hello everybody, my name is Mark. Welcome to another video, and it is with great pleasure I finally get to talk about one of my favorite strategies in the world, the almighty diagonal spread. And here you can see I put on a diagonal spread with Uber. I bought two call options, $50 calls expiring in 2023. That is 2 years from now, 26 months. Spent $1,400 a piece, total cost $2,800.81 and some change. And then I sold one call option, 52. That's actually a 2-to-1 ratio. I will get more into the details later in a minute. And I took in $73 expiration in a week. So let's, before I get into all of that, let's talk about what is a diagonal spread, and let's go through the basics. And let's go to Uber and check out the option chain, since that's the stock that I am trading. So let's go to the option chain and let's pull up some options. Now, you probably know what a credit call spread is. Let's go 21 days out. And or another way of saying it is you probably heard of a bear call spread or a bull call spread. So let's say that we go to out of the money like this. We're looking at the options 21 days out, and a bear call spread would be something like, let's say you think Uber is not going to go up past $55. It might go up to 54 or 53. So you sell this $55 call, and then let's say that you would buy a higher strike call and you would spend less money for that. So your 55 that you're selling, you would get 70 bucks, and then your 60 call, you would spend 22 bucks. So your net credit there would be 70 minus 22. You would get $48. The spread is $500. So if indeed that worked out, you're risking $500 to make $48. You would, if Uber did indeed trade below the $55, you would make an almost 10% return on your money, and that's a pretty good return. Now, that is called a bear call spread, but what you might not know, maybe you do know, but in case you don't know, that is also called a vertical spread, because the strike prices are vertically apart from each other. Same thing with a debit spread. If you bought the call because you thought Uber was going to go up all the way to 60, you would spend 55, and then you would sell it for 60, and your total cost would be 70 minus, you would be spending 48 instead of collecting 48. And if Uber went up to 60, you would have one nice heck of a payday. This 55 would be worth $500, and you'd make a lot of money on your $48 cost there. That is a bull call spread. But what you might not know, like I just said, is that is called a vertical spread. So logic would tell you that a horizontal spread is if the strike prices were the same. But obviously, you're not going to buy and sell the same exact call. So you would buy and sell different expirations. So what you might do is you might go to this one 49 days out, and you might buy this 161, this $55 call, spend 159, and then you might sell the same strike price call, 55, and you would collect money on that, and you would get 70. So your total cost on that would be the 159 minus the 60 minus the 70 here. I'm scrolling around. I hope you can keep up with me right there. So let's say 160 minus 70. What's that? $90. So it would cost you $90 to set up that trade, and you would do that if you thought Uber was going to go up a little bit, but it wasn't going to go up that much, and that would lower your cost on your call. And then when that one expires, maybe in after 21 days, maybe you might consider selling a 56 or a 57. Right now, those calls aren't even out, but in a minute. That's a horizontal spread. So a vertical spread is a bull call or a bear call spread. A horizontal spread is a calendar spread. Now, logic, right? If you know what a vertical spread is, you know what a horizontal spread. What do you think a diagonal spread is? That's right. It is when both the expiration and the strike prices are different. And so now let's go back to my Uber, and now let's take a look at what I've done. let's look at my transactions. So here we go. I bought a $50 call. I actually bought two of them. Don't worry about the 2-to-1 ratio. Just know that I bought a $50 call, expiration. It's a leap, January of 2023. And then I sold a $52 call, and that expiration is December 4th, 2020. That's a week from now, so that's a heck of a diagonal that I'm doing, right? But you can see 50 is different than 52, and January 20th of 2023 is different than December 4th of 2020. So if I was to go to the option chain, let's go back to Uber and check out the option chain. This is what it's going to look like. So I go all the way to 784, and you can see that that's about the price that I got it for. The bid is 14, the ask is 15.20. And then the one that I sold is this one here, the 52, which has already dropped a little bit. And now I got $72 for that. Now it's down to 66. In 7 days from now, if Uber trades below $52, then it's going to be worth zero, and then I can sell another one. So how do you make money in this kind of diagonal spread? So let's take a look at my position here. So back to my transaction, and here we go. So now pay attention and put your mind on the ratio here, okay? I bought two Uber call contracts and I sold one for a reason. If we look at the Uber chart, okay, and actually let me go to another transaction that I made, okay. Back on the 6th, I did an option butterfly on Uber. Why did I do that? Because at the time, let me pull up my draw here, the 6th, would be the 6th right here. And all of this move was Prop 22, and this move was earnings. Okay, now if we get rid of all of that and I go to November the 6th, this is where I put on the trade. So all of this part was not here. All that was there was if I just do this, this is what the chart looked like. Okay, and so I didn't see all of that other movement because it hadn't happened yet. It just looked like this. All I saw was a big jump. And so I expected a pullback. I thought, well, investors are getting giddy. They're getting very excited. And I expected a pullback. So that's why I put on the option butterfly. I didn't see all the other move that now has taken place. Stop doing that. Okay. There. Now all this other move is in. Let me get rid of that. This all wasn't there. So I expected a pullback. And so the pullback now I see didn't happen. And now what I see, and that's why I'm putting on this diagonal spread, now what I see is an uptrend. So I don't know if this counts as support, but maybe it does because you got that little part there. But here, this definitely is support. That's a definite support. And this looks like another support. So that is a basic standard uptrend. So it only makes sense for me to put on the diagonal spread because I don't know how long the uptrend is going to continue. Trends come to an end all the time. You cannot bank on these, right? So I'm not going to go buying the shares. I prefer to buy the options and to try to hedge my position as much as possible with these kind of spreads. Okay, so going back to my position now, so that's why I bought two calls because I am a bull. If I was not a bull and I thought it was going to stay flat, I would just do a basic diagonal spread 1-to-1. But because I am bullish and I do believe the trend will continue up and I do believe that Uber will continue to go up, then it makes sense for me to buy two calls and sell one call. Now, how do you make money? How do you lose money on these kind of spreads? Now, the risk is obvious. If Uber were to tank down, then I got $2,800 at risk. And somehow I would have a decision to make. Either I got to start selling a lot of credit call spreads or I just got to get out, take a loss. So that's the risk of the diagonal spreads. Diagonal spreads are risky, just like any other strategy. There's always a risk. But there's also a good way that you can make money. And there's two basic ways that you can make money in these kind of diagonal spreads. And the first way, because I did a 2-to-1 ratio, the first way I can make money is if Uber goes up. Okay, so watch what happens if Uber goes up. Let's go to the deltas of these. So first, let's click on the option chain here for Uber like this. And let's go to my option chain. And let's look up some deltas. So let's go to Greeks like this. And now let's first go to my short delta. So my short delta for the 52, I'm actually already on the month, December the 4th, 2024. My short delta would be 33.8. So that's how much money I am losing if Uber goes up. But I got 2 calls, and the 2 calls that I got are $50 calls, and those deltas, and I am now at January 20th, 2023, those deltas are 66, but I got 2 of them, so that's 66 times 2. So that is 132. That's $1.32. So I am losing 33, but I'm making $1.32. So that's almost a full dollar. And the more the delta the more the underlying goes up, these deltas will change. Now notice this gamma is very low. It's only 11 cents, but take a look at the short gamma. That gamma is actually that gamma is not that high. I would have expected to be higher, but I need to explain. The gamma tells you how much delta is going to change. And let me take one more check. Okay, I was wrong. This gamma is only 1 cent. Sorry. So there is a big difference in the gamma. So my bad. So the gamma on the long call, the leaps, is only 1 cent. That means delta is only going to go up like by 1 cent. But the gamma on this short one is 11 cents. And that one, is 13 cents on the 50, and that tells you how much delta is going to change if Uber stock goes up or down. Now look what happens in a week from now. Look how high this gamma is. This is a 71 gamma, and that's where you can really have to be careful, and that's why I bought the 2 call options. That way I'm not going to get burned on a delta if I have a straight up 1-to-1 ratio, because think about it, if I have a 60 delta and this goes up 71 cents, and eventually all of these calls, all of these options, their deltas will go up to like a 9. Okay, that's what happens when you get into these spreads. So, and notice this 48 is already at an 82, and it still has a week. So when the delta gets that high and you have a 1-to-1 ratio, you saw my delta on the longs, it was only looking at a 66. So imagine holding 2 stock options, 2 call options, and you have a delta of an 80 and you only have a delta of a 66. You're going to be losing money every single dollar that it goes up. And when I first started doing diagonal spreads, I didn't understand that. And I just thought, I'll just roll it up and roll it up, roll it up. And I was continuing to lose money on a stock. I think it was Apple. I bought a 105 call, and I was selling like the 107s, the 108s, and then I was rolling up to 112, 115. And before you know it, I'm like $400 in the hole. And I was like, all right, something is screwy. Something's going wrong for me. And so I got out. And you have to know what you're doing. You have to understand what you're doing if you're going to put on these kind of spreads. If you don't, then you could get into trouble. But just know that that's the reason why. Let's close out of this and let's go back to my transaction. That is the reason why I bought 2 of them and I sold 1 of them. So I'm not going to have that stinking issue again. Okay. Now, if Uber does go up, you saw the delta, that is one way I can make money. Then I can close out of the trade, or I can make an adjustment, or whatever. Now, the other way to make money on the diagonal spread is through the theta, and you can see the theta right here. Now, visualize in your mind, use your imagination, okay? I spent $2,800, and that $2,800 is a risk spread out over 2 years, okay? I have 26 months to make money. I can hold these 2 calls for 26 months and I don't lose. I'm the option buyer, by the way. That means I have the right to buy or sell. So I don't have a risk of getting exercised. That risk is in whoever sold me those calls. So I can hold these till kingdom come. This call that I sold, that one is different. I'm the option seller. This one does have a risk. So obviously, if I see Uber go past 52, I would consider rolling it up, or maybe just closing out of the trade altogether and taking my profit and setting up a different option trade. Okay, but visualize in your mind, you spend $2,800 over 2 years, and you have 2 years to make money on this. Now, imagine every 9 days, that's when I first sold the call on the 25th, it expires on the 4th. That's 9 days. Imagine every 9 days you're making $73. Now, 9 times 3 is 27. That's a month. Okay, 77 times 3 is 210. So let's say I'm making $200 a month, which is less than what I'm bringing in. 73 a week would be more, but let's round it down, make the math easy, and say I'm making $200 a month. There are 12 months in a year. So in 12 months, I would make $2,400. Already, I almost have this paid off. Then in 3 more months, I would make another $600. I would have $3,000 in 15 months, and then I could hold these another 9 months. I could continue to sell and sell and sell. So those are 2 ways that I can make money. Now, obviously, if Uber drops and it goes down to 45 or 40 or 35, I'm going to have some issues because these calls would be in the hole and I'd have to sell some low strike prices. If Uber goes to 45, maybe I could sell the 46s or the 47s. If it goes to 40, or God forbid, it goes to 35, then I got to sell 36s or 37s. I don't know what I'd do at that point, but for sure, I'd have to take some risk on the short side, or I would just have to close out of the trade and do something altogether different. But that's the basic idea of a diagonal spread. I hope that you guys were able to keep up and follow with me. Options are really a wonderful vehicle for you to invest your money, to trade, and the diagonal spread in particular is one of my all-time favorite strategies in the world because it's so flexible and I enjoy managing the risk, trying to make money here, trying to stop the losses there. And it's something certainly, I would say if you're new to options, I would not start out in the beginning with these kind of spreads. I would get your feet wet by just selling some puts. I've done tons of videos on how to sell the open put options. And cover calls, I think you got to be a little bit careful with because there's a lot of misinformation about the cover call strategy. But those would be 2 to get your feet wet. Then maybe move on to some credit spreads or some bull call spreads or whatever, and then maybe you can get into some of these diagonal spreads. And finally, as I close this video, the last thing I want to say is you got to pick the option strategy, whatever the market calls for. Don't go into trading options saying, I'm going to trade covered calls, because you'll pick a stock and then the stock will tank and you'll be big time in the hole. If you see a stock tanking, then you need to consider doing some credit call spreads or even some bull put spreads. You got to pick the option strategy that matches the market conditions. You can't force your favorite option strategies into a trade. So that's it for this video. I hope you enjoyed this video. I know it went on a little long, but I think the video and the subject matter warranted it. If you have any questions or comments, feel free to leave in the feedback section. Leave a comment, hit the like button, whatever you choose to do to show some love and support. Thank you for watching. I will see you in the next video. Have a good day. Hope you all had a happy Thanksgiving, and ciao.